Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, June 22nd, 2020. It is 11:12 a.m. Eastern Time as I'm starting the video, and what I'd like to do in this one is just kind of an all-inclusive potpourri mix of some of the things that I'm watching. Not individual stocks. We'll look at the stock market. Start out here with the stock market, touch on gold, natural gas, crude oil, silver, the US dollar, euro. All the things I've been highlighting recently that look like they're potential trading ops. And time permitting, I want to hit on the commodities, agricultural commodities that is, and if not, I'll get to those separately. So if I breeze through these, they're updates to everything that's been highlighted recently, and you can find those the previous analysis on the site. Let me show you how. Okay, so any posts that you're on, if like the one I'm about to do now, well, this isn't it. This is the one I did earlier today. Down here you have these symbol tags. So if I cover something, and let's say it's in this case DX, those are dollar futures, and you can also trade the ETF, UUP. They're both related. So you click on that, and it'll bring up all analysis on there. So as I go through the video, if you see corn or soybeans or something else in there, you can get to it that way. And you can also go in here under resources, the right side of the chart, support center, down at the bottom here, and just do it that way. If you want to see what I've talked about cotton, there it is, cotton. I haven't talked about that in a while, but that'll load all parts, all posts I should say, that include an update or analysis on cotton or whatever you're selecting from there. Okay, let's dive into the chart so we can kind of go over a lot of different things. Not much to say on the stock market. It's flat today. You just saw it tick as I opened that chart. It was at flat at 0.00%, and now it's up to 0.001. So flat market. We had the sell signals a week ago or so, a little more than a week ago now, 2 weeks ago, and we had an initial snapback rally. And we've been drifting lower, but not impulsively. So what I've been saying recently. I think it's objective to be short, but I don't think all in. The price action's been very strong on the rally, and since that sell signal is powerful and as clear as it was, as I said, there's a lot of support below, and so far since the initial snapback rally we're drifting lower, but not very impulsively. So in other words, price action's kind of the cross current here is that short trades for the time being are still swimming against the tide, the overall tide, since that move off the bottom there. Yes, the stock market's still below all-time highs, the S&P 500, but again, right now, the Fed has a very heavy hand in this market. So I'll be honest with you, and I've been saying I don't have very strong convictions on anything right now, because one thing the Fed has done by coming in nuclear, after, during that whole drop down, is they've distorted or outright destroyed the age-long mechanism of price discovery, which is where buyers and sellers interact. In other words, we used to be able to glean clues at times, not all the time, but at certain times you could glean clues from things like junk bonds and credit spreads. Those are the difference that high yield or junk bonds pay over treasury bonds, and that would usually signal a crack in the market. And quite often some of the biggest drops have been foreshadowed by those divergences or increases in credit spreads, where all of a sudden the yields start going up on junk bonds, low-rated debt, and compared to treasuries. Why is that? Well, the smart money, the smartest smart traders, institutional traders, they're big into the bond market. Retail traders don't really trade bonds actively, and many of them don't even own bonds or bond funds. But again, that's where the smart money can see that in advance of a company maybe where there's increased risk of default. Those are the things that really impact junk bonds. And again, we can't see that now. It's the Fed has made it very clear at all costs they're going to support that market. So you can have the credit low investment grade or below low end of investment grade, below investment grade area of the corporate bond market could have huge cracks, and probably does right now, but we just can't see them because the Fed's not letting prices go where they would be without them. No doubt that junk bonds and a lot of other things would be way down there. So I just wanted to say that, and it kind of goes into positioning. So we need to be selective in this market. In other words, the easy money does not come from going long or short the S&P 500 or even the NASDAQ 100 right now. And the risk return is still not favorable. So like I said, you know my thoughts on that. I posted charts this morning, and we'll update those real quick. Well, let's look here on the 60-minute chart. I already gave you the futures this morning. This is what SPY looks like on a 60-minute time frame. We had all those gaps. 3 of the 4 big recent gaps, 1, 2, 3, 4, were backfilled. We bounced back up, stopped at this gap. That's it. There's your initial leg down with the sell after the sell signals, kickback rally, which fell shy, and so we've started the next leg down. But until and unless we take out these recent lows right here, it's hard to say with a strong degree of conviction, are we in a new downtrend? So right now we're right here. We need to take out that previous low, and then we can say, yes, now we are, the tide has turned, and we are no longer in an uptrend. We are now in a downtrend. Right now, we can't say this is anything more than just a correction from overbought condition and extreme sentiments and all that. So there it is. And again, I still, favor being short, but not aggressively short. I hope that's clear. And then on that, we look at futures. NQ, as I posted this morning, was back testing this trend line right here. I'll color it up, and we still are, and that's it. So we had a divergent high there, little correction, pushed up, made another second, extended the divergences, a little bigger drop, and this is a back test. Will we be rejected here? I favor that, but again, the market's been resilient, but I do favor it. Let me just be clear on that. You can see these big divergences right there, just like we had, nice big positive divergences at that low that was a catalyst for the rally after that big drop, and just like we had negative divergences leading up to this high, which were about equal in scope, as you can see, even a little smaller than the current divergences. The only difference is back then when you had the sell signal, boom, that was it. You can market immediately reverse trend. It was impulsive, everything you want to see. A lot of check marks for a sell signal back then. Whereas here, we're kind of moving sideways more so recently. And that's, again, so the price action is been more bullish than it was back here. So that's, again, why, those sell signals, so far as powerful as they were a couple weeks ago, the follow-through hasn't been very convincing for the bearish case. And it could if we start to roll over and start to take out those previous lows, and that's what you look for. This is just NQ. You look for the same thing on SPY. You want to see pretty much this recent trading range here. Boom, we need to break that to the downside, and then you'll probably have an impulsive drop. My guess would be, a little hiccups along the way, but at least to down around this level here. And then for you ES traders, S&P 500, I know that's the euro. I'll get to that in a second. ES is right here. We've been, as I said this morning, we had the initial leg down with the big sell signals a couple weeks ago, and that went like this three-way pattern. It's a pretty strong snapback rally, but we fell well shy of the highs. There's our previous highs in ES, the S&P 500 futures, negative divergence at that high, clean sell signal, clean trend line break, everything you want to see. Snapback rally was pretty impressive, but again, it's stalled well shy of the previous high. It keeps that sell signal intact. And if you look at it from this point, we had a small divergent high right here. I had it on that chart this morning. There's your little divergence line right there, about almost flat line on the RSI. Small divergent high there. And we have been stair-stepping lower in a downtrend, just more of almost a sideways, but it is slightly down. So that's it, and that is the trend right now. From this point, the very near-term trend is down. From here, it's kind of not very clear. So this is the trend I'm looking at now, and so very near-term, we're down. And if I take a step back again to the daily chart, which we're on before, the trend off the March lows is still in an uptrend. That's not been called into question yet, because this near-term trend is down, and because it comes on the heel of these big sell signals. This is still the scenario I'm favoring, more downside. So if you are interested in shorting or going long or playing the indexes, I view this, any bounce back to resistance such as this trend line or that 31.14 level, or I had a line on the chart this morning. I'll put it right here. I had hand drawn that in after I took the screenshot. See these two reaction highs right here and here, really about three, all in that area. 1, 2, 3. 31.47. That should, quote unquote, should cap any advance. That's 3 failures there at that level. They pop that, I would put very good odds that they're going to pop those previous highs in the S&P and negate those sell signals that we got. So that's where we need to remain below to keep the bearish case alive. And the earlier we reverse on these bounces, the more bearish it is. So if we continue to see this, you'll probably see more longs capitulate, more shorts be emboldened to jump back in, and then you'll start to see a more accelerated drop would be my guess. Otherwise, it goes the other way. If they can pop it here, they pop that level, you'll see those that shorted or are short right now probably cover, and you'll see more longs probably jump in at that point on, trying to ride the wave up to new highs, or at least take out that high. Remember, this was just the recent high from early June, not the peak back in February. And that is because we're looking at a 60-minute chart, hourly candles, 60-minute candles, only going back 1 month. No, that's what you're looking at here, 1 month of price action. Next up, gold and silver. I won't spend too much time because I've done quite a few updates there, but so far everything highlighted recently is the bullish case is intact. The near-term bullish case to be long gold over the last week or so. It started out with this. We've had this multi-month trading range. It started after the recovery from the big drop into the February low or March lows. Then gold kind of has been slogging around sideways in a big range. It's a tradable range, but it's a little bit sloppy. We had a couple whipsaw signals, breaks down below, including this one that put in a divergent low, and then we came back within the range, and that was bullish. The fact that we had a breakdown and then a recovery, as I said, that gives you what we call a bear trap. Shorts get sucked in, they short, then they realize they were wrong. Longs that got shaken out said, oh, I want back in, we're back above that level, and so far it's been moving higher. And then as I mentioned on Friday, we had these trend lines to watch last week, which were since taken out. They were both silver and gold broke above these downtrend lines on Friday, giving you next objective long entry, and so far so good. This morning when I updated, we had broken above that 1756.50 first resistance level that I had last week, and we were back testing it, which provided an objective long entry, and we've moved up. So being that we're close to the highs, high end of that trading range, we'll probably make a run at it, but keep in mind it's been a sloppy trading range, and a few times we fell a little shy there. So again, are my convictions super high? No. Why? Well, because we're still in the middle of a trading range. So near term, I think there may be a little more upside. I think the risk reward is favorable. And it depends where you took it, of course. If you took it on the breakout, you put a stop there, you raise your stop. In fact, we had a reaction off that support level, reversal. So maybe under today's lows would be an objective area to raise your stops right now to protect profits, or maybe a break even if you took a breakout above there, and let it continue to run. But the bigger picture remains, if and when we get a definitive, a solid breakout above or below this level, that will most likely determine the next trend in gold. I'm leaning that way, but I am not sold on it. There are still negative divergences that were recently put in place on the daily and even weekly charts of gold. So I'm open to anything here, and you have to be in these trading ranges. You're going to have you may or may not have your suspicions on which way it's going to break, but these things can break either way. I've done this long enough to know that don't get married to any one view that gold must do this or must do that. Respect the price action, and right now, like I said, we're in this trading range, so recognize it for what it is. Is it an objective long here? Probably not, because we're so close to resistance. So if you didn't already have a position, maybe you could add on, but wouldn't start take a full position here if I didn't have anything. Your next objective long will be on an impulsive break above the 1790-ish resistance right there. SI, silver, again, same thing. I'm not going to spend too much time on it because we've already covered it. Most importantly, we broke above the downtrend line on Friday, broke out there, back tested it successfully, and we're close to a back test now. So silver does offer another objective long entry. If it comes down and back tests again, you're also going to have uptrend lines, so potential uptrend line support. We don't have a lot of reactions there, but you can see this little triangle top pattern. And remember, we're coming off a divergent low, and silver, like gold, although the top of the trading range wasn't defined at all, not like a parallel price channel like gold, the bottom of the range very much was. That line about 17,258, you can see numerous reactions along that level, as I'm showing you here, that define that. So that was just a little brief whipsaw, put in a divergent low like gold, and we've been walking higher since. So that put the near-term trend, bullish. But bigger picture is we're still in. Again, the top of that range isn't boxed in very well. If you wanted to box it, actually what you would do is exclude, I think looking at this, is maybe exclude this little pop right here and come in like this, if I can with my box tool, right about there. That's probably better defined because you see more reactions along there, but again, not perfect. So those are the levels to watch favoring that, and it all has to do with the technicals here, the divergences, everything else, the fact that they are in a bull market. Silver and gold are in a bull market. So the divergences I mentioned a minute ago on gold on the daily and weekly time frames have played out so far, but mostly for a correction in time. And as I spoke about recently, the dollar had been moving up, and which is normally bearish for gold, and yet gold kind of held its own. So net that was bullish, the fact that gold has shrugged off some things. Now, so here's what we're looking at. Since this morning, since I did that update, we have now triggered a sell signal in the dollar, but we hit our first support. So what I was talking about, we had a buy signal here in the dollar. And remember, the dollar tends to move inversely to gold. Rising dollar is net bearish for gold, where a falling dollar is net bullish. It's bullish for gold. Doesn't mean that every time the dollar falls, gold goes up, because there are other variables, other supply and demand factors, and their own technicals and everything else that gold or silver might have at the time, particularly gold. But there's the negative divergences. This is your bearish rising wedge. There's a breakdown. It's pretty impulsive, but the problem with it, is an all-in type sell signal. Is, as I mentioned earlier today, we have pretty decent support there at about 97, just above 97 on the dollar, and you can see that's where we hit. We had a slight brief momentum fueled overshoot, but we're pretty much parked on that level. So if and when this goes, or keep it simple, today's lows in the dollar, that should open the door for the next leg down here at about 96.411 or so, and that should be a boost. If that happens, that will most likely bring gold up to, possibly above, but at least up to the top of that trading range I just showed you a minute ago on the 60-minute chart. All right, so that's that. I'm just going to point something out, but I really don't want to put too much into it, but just kind of eyeballing this, if I didn't already. Kind of looks a little bit inverse head and shoulder-ish right there, with the left shoulder, head, right shoulder, and an upward sloping neckline. Now we may have a double shoulder right here. Sometimes you get that. So that's something to watch, because originally I had gold after this breakout going to max target up here about 98,746. So something to watch. In other words, if we hold this support reverse, this proves to be a false breakout or breakdown, and we pop up much above that recent high, that could open the door for that move. It's not what I favor. I favor this, but trading and analysis is all about reacting. The charts are dynamic; they change constantly, so you have to react and accordingly. Don't freeze like a deer in the headlights. If all of a sudden the case for being long gold starts to dissipate as we break those support levels I just highlighted in silver and in the dollar and all that, then you might want to pull the plug or go the other way. Sometimes you can reverse the trade and profit. Okay, now gold, let's see, this is from, I guess the long time. Let me find a different board. We've already hit our third target, although that was based on the daily. I'm here on a 60-minute time frame, and what I just want to show you, I'll turn off all the lines, make it simple. Let's try not to extract too much from the technicals. And I'm doing this because I know a lot of traders don't trade futures, but there's that range you can see right there. Now, gold is at the top of the range. GC isn't. Why? Well, remember, gold futures trade virtually 24/7, whereas we're looking at GLD, the ETF that only trades Monday through Friday from 9:30, at least on the candles here. It's not showing any pre-market trades, 9:30 a.m. to 4 p.m. So you're going to have different reaction highs, and that's one thing. And I'd like to use the futures. I think globally you're going to have more traders trading gold futures than and it's also, again, it's showing you what's going on over in Europe or Asia at the time is going to the gold futures here in the U.S. Will be reacting to prices overseas. So I like to use the futures, but I'll hit these charts, hit on these, touch on them for those of you that don't trade futures. And again, this is the bigger picture right here, not the bigger picture, the intermediate term picture, that is the 60-minute kind of slogging around. But now when you see it here on the daily chart, it is gold is pushing. This is the same range I just showed you on the 60-minute, but it's boxed in here on the daily, and we're testing the top of it, so we could break out. And there is that whole tail wagging the dog thing. I've talked about this in the past, where some ETFs are so large, and this is one of them. I've known a lot of big hedge funds, institutions that will use GLD as a position, not gold futures or not physical. They'll buy the ETF. It's just as easy for them in liquid, because it's so actively traded, to get in and out. So therefore, where I'm going with this is, buying pressure on gold. Maybe gold breaks out here above this range, and then that triggers a lot of buy orders in gold, and the shorts cover. We get a breakout, and that may then bring the futures up to and above that level. In other words, GLD may break out first, and then that could trigger a breakout in the future. So either way, we're close. We're right there, so we watch that. And again, it's a multi-month trading range. A breakout could be powerful. Fake outs are always a possibility, so what do? You know, if it breaks out and it looks like it's going to run, but then all of a sudden we do this, anything more than just a back test a little down below, you get a little bit of room. Sometimes they come in a back test and they'll come inside a little bit, run the stops. But if, you know, gold were to reverse suddenly and all the way down here, that's safe to say that's a failed breakout, and that could be pretty darn bearish. So you don't want to see that. But this could happen, and we could just, you know, continue to run up here, because this is like energy building like a coiled spring. So there's a potential for the next leg up in gold, and that would on our official trade, which is on board 8, I think right here, we still have a final target up here to 172.55. There's that divergence I'm talking about. We had it here, we have it here, but it keeps extending. And so I showed you, I believe I showed you, and if I didn't in a recent video, you know, we could do this. If it's a powerful breakout and we get there pretty quick, we may put in a divergent high that looks something like this, and then that would be a great time, number one, to exit, maybe even reverse to a short, close out that long position for those that have been in it for a while, or wherever you take it. You can take it here. There's still, you know, enough meat on the bone there for a trade, a little swing trade, about 4% or so. Of course, if you're trading gold futures, a 4% move because they're leveraged, it's pretty nice. GDX, which I'll get to in a second. But again, that's one scenario to look for, and I'm leaning that way, but we need to see a little bit more work in gold to get it. Silver, a few silver traders. Silver, you know, similar thing. It's, you know, different boards here. Chart's a little more sloppy. It's going to follow gold for the most part. If gold makes that breakout, silver will most likely follow. It's not guaranteed, but most likely they tend to trade together. And then for those of you trading GDX, the miners, same thing. The miners will follow gold. Like I often say, they're basically a leveraged play on gold. If gold goes up X, they go up X times whatever that number is. It's not a set constant. I can't say 2 times or 1.5 or 2.3. It's usually a good percentage above what gold will. In other words, if gold rallies at 4% up to that next target, then I could easily see maybe a 9-10% rally in GDX up to that line. Let's see why I have that line there. It might have been support from or resistance from way back when, but that's something to look for. And like gold, the miners could you know, put in a divergent high should that happen. Should they go on to make a marginal new high, meaning slightly above that previous high or somewhat above it, there's still plenty of room here. We'll do this. We'll extend the lines like this. There would be your divergence line, maybe a run up here, put in a divergent high. Right now, what I can tell you is the PPO is turned back up. It's turning back up right on the 0 line. I use this on many securities to delineate bullish and bearish trends. Look at the 9 EMA, the signal line. When it's trading above, that's the white line. When it's above, the trend is bullish. When it's below, the trend is bearish. And although here it was mostly a sideways range, it would at least got you out of longs. Then it doesn't look like much, but that was an uptrend. Captured all of it. That was a downtrend, and here we are. We're in an uptrend, a buy signal from this point, and the 0 line often acts as support when tested from above or resistance when below. So this would be your bullish scenario right here, and it's the one I'm leaning towards. Of course, if I'm leaning towards the bullish scenario in gold, I'm going to lean towards the same thing usually with GDX, and because of all those reasons, that's the way I'm leaning. Okay, and whereas we need to watch this level, we had a sell signal there, but unfortunately we have pretty decent support just below, so we need to take that out. Many possibilities, but things to look for. If we bounce and we get a back test, maybe a rejection there. But again, the next objective short entry on the dollar or sell signal, which may be you might be trading the dollar, but you might use it to help align with an entry or an add-on position to gold, and that would be a break of the lows there. And then the other one I like to cover because it's going to impact the dollar is the euro, largest component of the US dollar index, and the euro is in this big potential bullish falling wedge pattern right here. You have divergence. Here's your divergence line right there, your positive divergence on the indicators. And here's a downtrend line with 1, 2, 3, and now 4 reactions there. We had a little reaction so far. So this would be your bullish scenario. Unfortunately, like the dollar has is at or just hit support, the euro has a pretty solid, pretty well-defined resistance level above at 113. So to help seal the deal on a breakout, that's what you need to do, is take out that 113-ish level right there, and then that should open the door for a rally in the euro, which this one moves with gold, because remember, euro up is dollar down. So this, again, everything that I'm seeing points to the, most likely to, a breakout in gold, or at least some more upside here in the near term. And an update on crude. Crude's going to hold up. The case can be made here for an objective short, very much so. You have right here, you had a nice clean up trend line back there. You had negative divergence forming. You had a little correction first with that first divergent high right there, you can see. And then we continue to push up, put a divergent high here, and then came your sell signal on the breakdown, and that was breakdown. We had a little kickback rally. It fell shy of the highs. And then before all is said and done, you had a nice drop, a tradable drop in crude. And again, that came off that divergent high. So here we are, wash, rinse, repeat, back to a divergent high. I probably should have had it here. Highlighted before. I had to replicate this chart today. The old one expired. The futures had rolled since my last chart, so now we're on the September contracts and a continuous contract. But that was a bullish right there. Divergent low, positive divergence led to this rally, which is still going on. In other words, we're at resistance. We have you can make a case, an objective case to short. It's counter trends. It's a little more aggressive. You're at this 40-51 resistance. There's 1, 2, roughly 3 previous reaction highs. We went a little bit above there, so there's a little more room for an upside move in crude to still say you're at or around resistance. And any marginal new high anytime soon will still be a divergent high. You can see. In fact, we'd have the RSI divergence. Remember, we didn't have RSI. No, we didn't have it here. We had just PPO divergence like we do now. So this is my scenario for CL. Either a breakdown before then, maybe a marginal new high. I think the upside's minimal upside, most likely, but again, it depends on what this market does. The stock market's been resilient. If the stock market can burn through those sell signals, you're going to see equities rally, and therefore crude will probably rally both on increased or increased optimism on what rallying stock market will be. Expectations of future growth, being picking back up and increasing from where we're at. And it cuts both ways. So if the stock market breaks down and you start seeing equities move lower, take out the recent lows, you'll probably see crude break down. Now, they can trade on their own. They tend to trade together. So, keep an eye. There may be a trade to be made even if the stock market holds up and you get that breakdown. But most importantly, that's it. So you can either short here at resistance. I would not take a full position because of the fact the trend is higher. If they pop that, they may run up. And we're so close to that downtrend line, you could just wait for there. So at most, maybe a half position. Or if you're already in it, I would hold off again until we get a sell signal and a break at that trend line there. And there's going to be some minor support I should point out right here. And then I'll give you guys a USO chart right there. There's some minor support just below about 39.48 that should be taken out as well. If you don't trade futures, there are many different ETNs out there that track crude oil, but USO is the most liquid and it doesn't have leverage, so you have a little less risk than the other ones. And so you might want to look at this. Same story as I've highlighted for weeks now. Crude rallied into this big gap right here, very significant gap, backfilled it, failed at the top of the gap. We're still in it again. So I can't really take too much from that daily chart there. 60-minute chart. Let's see if I have anything marked up here. Yeah, we had a series divergent high here. We're kind of moving sideways right there. Yeah, I prefer to use the chart of a CL right now. This one's just not that clear, the USO chart, at least the way I have it marked up here. It does a pretty decent job of tracking. Not perfect, but a pretty good job of tracking crude futures. Okay, and finally, let me just hit on just a handful. We'll look at just 5 commodities that stand out right now. Kind kind of been a failure to launch in some of these. We keep getting these potential bullish setups, but they're trading ops. Where I'm going with this is a lot of these commodities remain in downtrend. Some of these are in near-term uptrends, so I'll be clear on that. But wheat, for example, continues to give us these bullish falling wedges. You can see downtrend lines, positive divergence. So we look for these divergent lows, and boom, there's a tradable trend to be made there. Tradable trend. You can get. It's not much. They're counter trend trades, but it's again wash, rinse, repeat. I just don't see enough in the charts to short. There was a divergent high there. I don't know if I pointed out at the time. That was really the catalyst for this next leg down, the divergent high plus a trend line break. But you can see these patterns, the little wedge type patterns, divergent lows. Go long on the trend line break. Remember, divergence is not a buy signal, but what's objective, you can go long at support. At this point, I wouldn't say that's support, at least not looking at it here. I'm only on a 2-month time frame. Maybe there was support, but it did act as support here because we had those reactions. And now that's going to be resistance. That's going to be a target if we break out. So where we're at now is we've come full circle after this divergent high right here. That was a catalyst for this leg down that we've been in, this downtrend, but we have now set up in a nice clean bullish falling wedge. It's pretty steep, the ascent of that wedge, descent of that wedge, that is. Divergence. Now that divergence can continue to build, or maybe it plays out now. Doesn't matter. We need a buy signal. That's the important thing. A buy signal will come on a break right there, about 490. You have a nice gap right there. Those, you're going to get gaps in the futures. The ones that shut down trading throughout the day. These ag commodities shut down early in the day, a lot of them, and of course over the weekend too. You're going to have the futures shut down. So there's a gap right there, and we've tested it several times from below. So if they can pop the gap, they're also going to take out this downtrend line. And I think that would open the door for a nice move up. Trade, even if it's a quick trade, it should be about 4%, almost 4% to that first target. And it has the potential to be more. Let's look at wheat, the ETN for you that trade ETNs. There's a daily chart. And the bigger picture on the daily chart is you have this more of an uptrend line. Now this might not mesh exactly with the futures on the daily. We were just looking at a 60-minute chart. But here it is. We have this. I'm not going to call this an uptrend because although we have a series of higher lows, that's part of an uptrend, we don't have a series of higher highs. We have roughly equal highs. So really at the top, what I could say is wheat may be in a basing pattern here. When you look at the long-term chart, a lot of these commodities have been in multi-year bear markets. And this can be, and I believe it will likely prove to be, a basing pattern. It could be a consolidation within a bear market, just like this was. There was a consolidation, but it broke to the downside. However, just like gold, if it breaks out of this trading range to the upside, that would be bullish. So there may be a longer-term trade here. And the other thing too is if you zoom back in, we're now looking back just 2 years, you are at support. You do have that trend line I just showed you that's starting to become fairly well defined. 1, 2, 3, and now 4 tags of that trend line. So if we reverse here, you could go long with a stop somewhat below, maybe below that previous reaction low for the next swing trade. Because here's, if you look at this daily chart, you can see my measuring tool will pop up on the box to the left towards the bottom in green. That's 18% off that last, if you stepped in there. If you stepped in here, and again, not that you're going to buy you could buy the lows by buying at the trend line. You could do it right now if that holds. Not to say you're going to sell the highs, but it was a 25% rally off that low. And you can trail stops up. Catch most of that, about 25% there as well. So kind of a wash, rinse, repeat thing, that even if we're just in a multi-month, multi-year trading range, nothing wrong with getting 10, 20, 30%, whatever it is. And again, bigger picture is if you get that and we get up there and you break above those previous highs, we may have broken out of a 18-month or so sideways trading range. It could have longer-term bullish implications. So that's wheat. Let's move on to the next one. Soybeans, SOYB. And soybeans, let's see if I have any annotations on this. Yeah, pointed out this recently. We had a divergent low here with this little wedge. We broke out. I had the first target resistance right here at 14.19. We hit it last week. We're consolidating under it. This one looks like it wants to pop that level, but it needs to. That's your next objective long entry. We had an objective long here on the breakout. That was good for a pop of about 4%. Nothing exciting. Again, these are agricultural commodities. These are soybeans. It's not the latest, semiconductor stock or anything else. So you don't have as much downside risk as you do on equities, but so you can use a little bit larger position size, and it makes it worth it then if you're getting 4%. But again, I'm looking more of a swing trade here, and you pop 1420 or so. That should take us up to this next target here, about 1474, and then the downtrend line. And like everything else, there's a potential here for a major bottoming play. You have this big divergence that's been forming here for a long time, much bigger than the previous divergence right here. There was your previous divergent low, divergent low, divergent low, rally, 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 and this is what I'm looking at. Something like this, come up here, hit that trend line, eventually take it out, and there's quite a bit of potential. You can see some of these marked targets. And for those that trade futures, ZS, soybean futures, this is a 2-hour chart covering 6 months. So every candle is 2 hours of trading. We had this beautiful breakout right here, the downtrend line. At the time I was drawing a potential divergence line. I would have covered that earlier, that if we made a new low, we would have had positive divergence. But again, that's not a necessity to see a trend reversal. It certainly helps, something I look out for. But we had a breakout, and so far soybeans have been rallying. Now it is worth noting right here, there's negative divergence at this point. Maybe they burn through it. The near-term trend since this point, actually since right here, you can see we have the making of an uptrend. The bottom there, higher high, higher low. I mean higher low, higher low, higher low, and so far higher highs. And so there's your, there's all the makings of a near-term uptrend. So if you're, a trend trader, you're trying to trade this wave, it's not very powerful, but it is an uptrend. So that's and that's what to look out for. There's some levels you can see that should hold. I think any pullback should be contained at 855 right here. That's pretty good resistance or support, I should say. There was this kind of smaller basing pattern here on these futures where we finally broke out right there. So that's where I'd look to have a stop somewhat below there if that level went, and a pullback to that level, or this one would provide an objective long entry for the next move up to any of these targets right here that you can see. I should have covered this one after crude. I meant to, but here it is. NG, natural gas futures. Positive divergence building right here. This one looks like it's setting up for a move right there. Sometimes crude falls and natural gas goes up. They don't always. They're not positively correlated at times, and that's due to many factors. Sometimes if there's an oversupply, a glut of crude on the market, they start shutting some wells down, and therefore the wells get shut down. Natural gas isn't coming out of those wells, so then the supply drops and the price can go up. So that's what you want to watch here. And so basically you have a combination or an intersection of downtrend line resistance and price resistance around 1728. Pop above there should trigger buy signal. I don't have any targets marked up here if you don't trade futures. And remember, on all these futures, just about all of them, you have mini contracts as well, the micro or minis. So if you don't trade NG, there's another one. Maybe it's QG. You might want to look that up. It's just a smaller, it's the same price levels I just showed you on that NG chart. They just use a smaller leverage factor. UNG, this is a daily chart. Here's an ETN that trades natural gas, and you can see a similar pattern setting up here on this daily chart, which has a little bit longer term implications. So there's a potential for UNG, just looking at this daily chart, if we break out of that wedge, could rally all the way at that $15 level, and that would be 44% return. What would that mean on UGAS? I know you guys love the juice, no pun intended. This is a crowd favorite. You don't want to buy and hold this one. You will lose money over time. The decay is vicious in this one because of the volatility in natural gas, and that 3-time leverage works against it. But where would it go? I'd have to sharpen my pencil. I think the comparable level would be up here, about 225%. And if you're wondering, well, how come it's not 3 times? What NG or UNG would do is, because these 3-time leverage ETFs, when they are in a strong trend, strong uptrend if you're long or a strong downtrend if you're short, they actually do better than 300% the underlying. It's the way the math works. I explain that, that can be explained right here under resources, frequently asked questions, go to ETF related questions, and then right here, what is the advantage or disadvantage of holding a leverage ETF for an extended period of time. And I talk about the math here where it actually can work for you instead of against you in the right conditions when you're trading those 3 times. The thing is, you don't want to hold them for long term, especially if they're working against you or if the underlying security is chopping around in a trading range. That's when the decay will eat at you. And almost done here. NIB, this is the cocoa ETN. I'm going to turn off all those lines. It looked a little busy. And most simple was the uptrend line that I had down there. And this one's been working its way up this uptrend line. And as talked about before, providing an objective long entry by simple and effective method. When you see a well-defined support level trend line like this, buy pullbacks to that support. There it is. So this was still near there. Your most recent objective long entry for a swing trade. Just trail up stops for the time being. This one's again, you don't want to call it an uptrend because we had this peak up here, but from this point right here, it's in an uptrend. You can see it making a series of higher highs. So from about right here, there's your uptrend line, but this point it is in an uptrend. So you buy it, and if that trend continues, we're going to take this previous high out. And so I'd be looking, as a trend or position trader to go long here with a stop somewhat below that trend line. Give it a little bit of room, depends on what you're targeting, how much you're holding out for, and it looks objective. And if you trade futures, CC or cocoa futures, and this is a 60-minute chart, and you can see we're coming off a divergent low there, positive divergence on cocoa futures after this pullback here. And again, that takes us to that trend line on NIB I just showed you, the ETN. And again, I don't see well-defined resistance level or targets. It's more of a just get in, stop somewhat below, and ride the next wave up if we're going to get one. Okay, just 2 more to go. Coffee and sugar. So this is coffee. Looks like a nice clean downtrend line. Coffee could run. Here's your big downtrend line, 60-minute chart. This is 3 months of price history we're looking at here. Let me make sure this one's refreshed. Some of these come in delayed. There it is. There's your downtrend line. Price resistance at 0.9881. We're coming up on it, and they come in together. So like a lot of the charts I showed you today, if you have 2 resistance levels in close proximity, give it the benefit of the doubt. Wait for the second one to be taken out since they're so close. That would be your buy signal. You could set an alert, go long there. First target, second target right there. That'd be a pretty decent run. And coffee, when it wants to run, can move really fast. So if you see the breakout, you may want to jump on it. And if you don't trade futures, JO would be the ETN for you. And I think I have it here. Yep, nice divergent low. Now here's the thing, we took out this support I mentioned a week or so ago. We took it out and then regained it. Looked like a fake out, false breakdown, regained it, but then we went down again. However, we still have positive divergence. So right now we really need to get, at least on this ETN, need to get back above here, but the futures might be telling us a different story. We have that trend line, so I like it, is what I'm trying to say, and I think we'll recover that level. And again, these rips and dips are pretty powerful in coffee. We've had this many times over the years as official and unofficial trades. Just kind of put it in perspective. Off these divergent lows, the rallies are 30%, 50% there, about 31% there, or from that point about 33. So you're talking well into the double digits. And again, it's all about risk reward. If you take a position in coffee, you get a breakout, 5% stop, let's say, for a 30% upside target, you're talking a 6-to-1 risk reward ratio. I'll take that all day long. So there's another trade idea for you. And last but not least, cane. This is one of 2 sugar ETNs that I follow. We had this inverse head and shoulders pattern, left shoulder, head, right shoulder. We had a downward sloping neckline with a breakout or a buy signal right there, initial leg up. Nothing goes up forever. Pulled back, consolidating. Could be ready for the next thrust up. Indicators are in bullish territory. The RSI above the 50 point, the midpoint, in back testing it, and the PPO above the 0 line right there. And that's cane. And sugar would be SGG. On here we had this wedge breakout, and it's been walking its way up, clearly in an uptrend after the breakout right here. There's a breakout right there. This was the last official trade. We hit our first target, then they clipped our stop one day, reverse back there, but I've been highlighting it since, and even back then said I still like it. So there it is. There's your uptrend, and that's it. Wash, rinse, repeat. The pull back to that former first target around 37. That was resistance before, and we hit it here, and it was resistance again here. That helped to validate it. So this was an objective long entry on the pullback right there to that level. After we took out that resistance level, resistance becomes support, and you know, I'm looking for the next leg up here to that next target, and ultimately up here what I had on that last trade is a final target all the way up here T2, but I gave you this intermediate target, so that's really your next one there, about 40-50 or so on SGG. Okay, a lot of stuff, long video, but those are the things I'm watching other than individual stocks, and I'll update those separately. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.